Hello, I'm Mark from Moonstone Publications. Welcome to this overview of some of the stories we've covered over the past week. But first, please hit the subscribe button and share this video with your friends and colleagues. Coming up in this week's update, a report from Standard Insurance maps risk and claims patterns. The Council for Medical Schemes publishes its contribution increase guidelines. South Africa faces a sharpened test of its anti-money laundering regime, and a draft amendment will narrow taxpayers' bona fide inadvertent error defense. A new report from Standard Insurance finds that short-term risk is neither random nor evenly spread. It's patterned and increasingly driven by climate volatility, asset life cycles, and changing behaviors. The report, based on analysis of 5 years of claims data, provides insights into when policyholders are most likely to claim during a policy's tenure and why. For example, water damage accounts for about 60% of household claims. There's a notable surge in claims around the 4th year of cover for burst pipes and geysers, and another at around 8 years for vehicle damage and windscreen repairs. Standard Insurance says the patterns identified in the report point to the need for prevention-focused strategies rather than purely reactive claim responses. The Council for Medical Schemes has urged schemes to limit their contribution increases for next year to 3.3% plus reasonable utilization estimates. The recommendation is tighter than last year's guidance, but history suggests major schemes will again impose far larger increases. The Council says household budgets are already being squeezed by high food and electricity prices and weak economic growth, and above-inflation increases will make healthcare cover even less affordable. The industry solvency ratio is more than 43%, well above the statutory minimum of 25%. The Council says these reserves can be used to shield members from immediate contribution hikes. At the same time, it warns against aggressive underpricing that erodes reserves and threatens solvency. South Africa faces a sharpened test of its anti-money laundering regime as the Financial Action Task Force has tightened its evaluation methodology. With a mutual evaluation for April 2027, the challenge is how supervisors and designated non-financial businesses and professions can demonstrate effective, proportionate anti-money laundering action. Financial Intelligence Centre Executive Christopher Milan says the FATF's immediate outcome 4 will scrutinise whether supervision is appropriate and whether non-financial businesses' preventative measures are adequate, not merely formalities, but risk-based, measurable practice. The reporting of suspicious transactions and robust market entry controls will also come under scrutiny. National Treasury and SARS have proposed a significant narrowing of the understatement penalty defence. The long-standing bona fide inadvertent error protection will apply only where the taxpayer's mistake results in a substantial understatement, an objective test set at the greater of 5% of the correct tax or 1 million rand. Under the current Tax Administration Act, almost any error can technically be an understatement, but a bona fide inadvertent error has been a full defence. The draft will de-link that defence from the nature of the mistake and instead make it hinge on the calculated prejudice to the fiscus. Practically, challenges to understatement penalties will move from proving the error was inadvertent to proving the taxpayer's conduct was reasonable. That's all we have for this week. You can read these stories and many more on our website, moonstone.co.za. Until next time, here's wishing you all the best from the team at Moonstone Information Refinery.